On a day that began like any other, the invisible currents of global finance unleashed an unprecedented fury, wiping out a staggering sum of wealth across the United States stock market. Screens flickered crimson, algorithms spiraled into a vortex of panic, and the titans of Wall Street watched in horror as their meticulously constructed systems seemed to tear themselves apart. This was May 6th, 2010, the infamous flash crash.
An obscure day trader from a semi-detached house in Hounslow, West London, whose singular obsession was about to unravel the perceived infallibility of the market. His arena was the futures market, specifically the E-mini-S and P500 future, a derivative contract that mirrors the movements of America's 500 largest companies. Sarao, however, didn't play by the traditional rules of investment or analysis. His weapon was an insidious tactic known as spoofing. In essence, spoofing involves placing huge orders for futures contracts with no genuine intention of executing them. These phantom orders would appear on the market's order book, creating a false impression of supply or demand. If Sarao wanted prices to fall, he'd place a massive sell order, making it appear as though there was an overwhelming desire to offload contracts. Other traders, particularly the lightning-fast, high-frequency trading HFT algorithms that dominate modern markets, would react, adjusting their own bids and offers based on this perceived shift. As soon as the price moved in his favor, Sarao would swiftly cancel his fake orders and execute smaller, genuine trades, profiting from the micro-movements he had engineered. It was a digital con, a subtle manipulation of perception that yielded small, incremental gains, day after day. Navinder Sarao operated in the shadows, a ghost in the machine. His setup was rudimentary by professional standards. A few screens, a custom-built trading bot designed to automate his spoofing strategy, and an internet connection. Sarao's profits mounted, sometimes millions a year. He was a master of the dark art of market inference, a lone wolf preying on the automated herd. The flash crash of 2010 began innocently enough. Early afternoon, the market was already reacting to news of the Greek debt crisis. Then, with terrifying swiftness, something broke. A massive sell-off commenced. Within minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, losing almost 9% of its value. The market's self-correcting mechanisms appeared to fail. Alarm bells screamed across trading floors, but nobody understood the cause. Was it a fat finger error, a rogue algorithm, or something more sinister? As quickly as it descended, the market partially recovered, but the psychological scars remained. $1 trillion had vanished and reappeared, leaving behind a chilling question. How fragile were the foundations of the global economy?
The sheer volume of transactions and the complexity of algorithms made it a labyrinthine task. Slowly, painstakingly, a pattern began to emerge. Amidst the chaos of May 6th, and indeed for years prior, there was a consistent, anomalous presence, a torrent of large, manipulative orders that would appear and disappear precisely at critical junctures. These orders, placed by a single entity, consistently preceded price movements that allowed small, profitable trades. On the day of the flash crash, Sarao had allegedly placed an extraordinary number of spoofing orders, manipulating the futures market with unprecedented intensity, creating an artificial wall of supply. This colossal phantom order, renewed 19,000 times that day, created a persistent downward pressure, driving prices lower. While not solely responsible for the flash crash, the market was already on edge, and numerous other factors contributed. Sarao's actions were seen as a critical catalyst, a lever that tipped an already unstable system into a terrifying plunge. In April 2015, Navinder Singh Sarao was arrested. The US government sought his extradition, turning his quiet, unassuming life into a high-stakes international legal drama. During his trial, a complex portrait emerged. Sarao was described as an intelligent but socially awkward individual, potentially suffering from Asperger's syndrome, who saw his actions not as malicious manipulation, but as a clever exploitation of market inefficiencies. He genuinely believed he was doing nothing illegal, just finding an edge. He even emailed the CFTC at one point, complaining about other traders spoofing him, a stunning act of naive audacity. Sarao reached a plea agreement with US authorities, admitting his guilt in exchange for a reduced sentence. In 2020, he was sentenced to 1 year of home confinement, avoiding prison time but facing hefty financial penalties to the unseen forces that govern our financial world, where an individual with a modest setup and a dark ingenuity can, from the quiet anonymity of their home, pull the delicate threads of the market